Welcome back to the deep dive. We're here to cut through the noise and bring you some real clarity, maybe even some surprising insights. Today, we're plunging into a term that, well, for some people, it might sound a bit intimidating, maybe. Hard money loans in real estate. But trust me, this isn't some dusty, obscure thing. It's actually a really dynamic, essential tool for smart investors across the U.S. Okay, let's unpack this.
Absolutely.
Yep.
Our mission here really is to pull out the most important stuff from all the sources we've looked at. We want to clarify exactly what hard money loans are, get under the hood. We'll explore why they're so important now in the U.S. real estate market, which is, let's face it, moving super fast. And we'll pinpoint when they make sense to use and exactly how they work day to day. The goal for you listening is simple. Walk away understanding this well enough that it can genuinely help your financial decisions, maybe even open up some new possibilities for you in real estate.
Yeah, and we promise this is kind of a shortcut to getting informed on this specific option. We've got some insights that might honestly reframe how you think about financing deals. Forget the myths, we're getting into the strategic reality. So let's jump right into the core question. What is a hard money loan? I mean, at its simplest, it's a short-term real estate loan. But the big difference, it's coming from private lenders, not your regular bank. Think of it like specialized quick response capital.
Right. And what's truly fascinating here, and this is something a lot of newer investors miss, is how different the loan's foundation is. Unlike traditional mortgages where they comb through your credit score, your income, your debts, hard money loans are primarily based on the value of the property itself. The actual asset, the collateral is really the star of the show. And that's crucial because for these lenders, that tangible asset, the property, it gives them a clear way to recover their money if, things don't go as planned. It sort of de-risks it for them, lets them focus less on your personal finances. It's a very direct asset-first approach.
That distinction changes pretty much everything, doesn't it? Our sources really hammer home a few key features that make hard money lending different. First, like you said, they're mostly backed by the property's value and its potential, not just how good your credit looks on paper. Second, they come from private hard money lenders. These could be individuals or firms operating outside the normal banking system. They step in where banks often won't. Third, they are explicitly designed for short-term use. We're talking typically 6 to 36 months. That's a world away from a 30-year mortgage. And finally, maybe the biggest draw for many, they have an incredibly faster approval and funding process compared to traditional loans. Much faster.
Yeah, and if we zoom out a bit, connect this to the bigger picture, the essence of hard money financing becomes really clear. It's basically an essential tool for investors when time is absolutely critical. Or maybe when a borrower's credit isn't quite perfect, or, and this happens a lot, when the property itself just doesn't fit into the neat little boxes required for standard bank loans. It fills a very specific, but surprisingly common, gap in the market. It lets deals happen that just wouldn't otherwise.
Okay, so that brings us straight to why these loans really matter so much, especially in the U.S. market today. I mean, anyone who's even looked at real estate lately knows it's fiercely competitive. Good opportunities don't hang around, they flash by. Whether you're a seasoned pro or just thinking about your first flip, you've probably felt that pressure, right?
Precisely. And hard money loans, they don't just offer money. They offer buyers the agility and the speed they need to actually grab those fleeting opportunities. They effectively slice through all that bureaucratic red tape that gums up traditional financing, allows investors to move decisively. So it's not just about getting a loan, it's fundamentally about gaining a competitive edge.
And when you look at the specific benefits for investors here in the U.S., they're really significant, especially now. Let's break them down. First, you've got fast, hard money loans, seriously fast. Imagine finding that perfect, maybe undervalued property on a Monday. With a traditional bank, you might be waiting weeks, maybe months, just for an approval letter. Forget closing. With hard money, you could potentially have the funds in your account in days. That speed. It can literally be the difference between winning the bid or watching someone else get it. Second, they offer incredibly flexible property options. Traditional banks, they often get nervous about properties needing big repairs or raw land without immediate plans, or even some commercial spaces they see as non-standard or just too risky. But hard money lenders, because they're focused on the property's underlying value and potential, they can step in. This opens up all sorts of opportunities for investors in niche areas like, say, a distressed apartment building needing a total gut job, or an undeveloped plot with future zoning upside. Stuff banks wouldn't touch.
Yeah, that flexibility is a real game changer. It lets investors be way more creative and opportunistic. Like, if you find that classic ugly duckling house in a great neighborhood, but it needs a massive rehab, most banks see risk. A hard money lender, though, They're looking at the after-repair value, the potential. That makes exactly that type of project viable.
Absolutely. And that leads right into the third benefit, access despite credit issues. Because the main focus is the property's value and your plan for it, your exit strategy. The requirements for hard money loans can offer a path forward even if your credit history isn't perfect. It means, past financial bumps don't automatically disqualify you from future real estate wins, as long as the deal itself makes sense.
That's such a critical point. Lots of really smart investors might have had a temporary credit dip for whatever reason starting a new business. Maybe a past market downturn hit them. Hard money ensures they're not just stuck on the sidelines when a great opportunity comes along. For the lender, the property's equity is their security blanket, basically, so they can be more open to a wider range of borrowers.
And finally, a benefit that maybe gets overlooked sometimes. Hard money loans help investors jump on seasonal and market-driven opportunities. Think about potentially discounted properties in the winter when sellers might be more motivated, or getting funding quickly in the spring to start a renovation project that absolutely needs to be finished and listed by summer. Without that fast financing, those tight windows, they just close on you.
Right. And here's where it gets really interesting, kind of illustrating that point perfectly. We found a quote from a local real estate investor in one of our sources. It captures this so well. They said, in markets like Las Vegas and Miami, where properties get multiple offers within days, having access to a private hard money loan can be the difference between winning a deal or losing it. It just highlights how critical that speed and access really are in hot markets.
Wow, that's a powerful statement. Really drives home the strategic advantage. But it's also super important to be clear. Hard money isn't the answer for every single situation.
Yeah.
Not at all. It's really best for specific short-term strategies where getting the funding quickly is way more important than getting the absolute rock bottom interest rate. It's a specific tool, right? Not a universal fix.
Absolutely. And our sources lay out several common scenarios where hard money lending really shines, often because traditional lenders just can't move fast enough or, frankly, stomach the perceived risk. These include, well, the classic fix and flip projects, quickly buying, renovating, and reselling homes to capture market appreciation and the value you added through repairs.
Ah, the classic ugly duckling scenario again. We've all seen those houses, right? Prime location, just needs serious work. And without something like hard money, they might just sit there while the traditional lender takes forever and the opportunity and your profit just evaporates.
Exactly. Then you've got bridge financing. This is super important for investors who need to cover the gap between buying a new property and selling their current one. Maybe you found an amazing deal, but your existing property sale hasn't closed yet. A hard money loan can bridge that gap so you don't lose the new deal. We also see it used a lot for auction purchases. Payment deadlines at auctions are notoriously tight, sometimes just days. Conventional loans, they just can't work on that timeline.
Yeah, impossible. And let's not forget those investments that banks tend to avoid. This could be anything, really. A commercial property with a unique use, maybe a house needing major environmental cleanup, or even land that's still waiting on permits. Traditional banks, with their strict rules, often just say too risky.
Mm.
Hard money lenders, being more flexible and asset-focused, are often better positioned to actually evaluate and fund these kinds of complex deals.
And just to tie back quickly to those seasonal opportunities we mentioned, think about the timing. Spring and summer, that's often peak season for house flipping and renovations. Lots of buyers are looking. Projects need to start and finish fast to hit that prime selling window. Quick funding is absolutely key to grab those properties, get the work done, and list before things cool off.
Right. And then, flip side, when you get into fall and winter, it's a different vibe, maybe less competition, so investors might find some really good deals from motivated sellers needing to close before the holidays or year-end. But again, these deals often require immediate financing, so hard money becomes invaluable to snap them up before someone else does. Imagine finding a gem in November and closing before Thanksgiving instead of waiting till February for a bank loan approval. Huge difference.
Okay, moving on. Let's maybe pull back the curtain a bit on how these loans actually work day to day, and importantly, how they stack up against traditional bank loans. The process for getting hard money is, well, significantly more streamlined, more direct.
It really is. Let's walk through the typical steps. You'll notice it's much quicker than the bank marathon. First, obviously, you need to find a hard money lender. These are private folks or companies, so you'll look for local or national firms that specialize in this. Second, you submit the property details. This is why you really focus on the asset itself, its current value, what it could be worth after repairs, the ARV, and your plan. Remember, the lender's mainly looking at the property's strength and your exit plan, not just digging through your personal finances like a bank would. Third, you agree on the terms. This covers the interest rate, the repayment period, short term, remember, and the collateral, which is the property. These terms get tailored to the specific deal. Fourth, you receive funding quickly, often within a week, which, as we've said, is a massive plus. And finally, critically, you need a solid exit strategy. How are you paying this back? Borrowers usually repay either by refinancing into a traditional longer-term mortgage once a property is fixed up and stable, or by selling it for a profit. Having that clear plan up front is non-negotiable.
Right. And just to put that into perspective, to really show the strategic choice you're making, let's do a direct comparison with traditional bank loans. We can pull some numbers from our sources here. Think of it like comparing a scalpel to a sledgehammer. Different tools for different jobs. Okay, approval speed. Hard money. Lightning fast, maybe 3 to 7 days. Traditional loans, that's a marathon. 30 to 60 days, sometimes even longer.
Yeah.
The fundamental loan basis is totally different too. Hard money is mostly about the property's value. Traditional loans hinge on your credit score, income, debt ratios, the whole personal financial picture.
And the loan term. Couldn't be more different. Hard money is short, 6 to 36 months usually. Built for quick turnarounds. Traditional loans, long haul, 15 or 30 years. Unsurprisingly, the rates reflect this difference in speed and risk profile. Hard money is higher, maybe 8% to 15%. Traditional loans are much lower, say 4% to 7%.
Which leads directly to the best use cases. Hard money is perfect for flips, bridging finance gaps, quick opportunistic deals. Traditional loans, they're for long-term homeownership or buying stable, already income-producing properties. And finally, flexibility. Hard money loans tend to be highly flexible, adapting to unique properties or borrower situations. Traditional loans operate within much stricter, more standardized boxes.
So, what does this all mean for you, the listener? It means a hard money loan isn't just another loan. It's a deliberate, strategic choice. It's a trade-off, really. You're usually paying a higher interest rate, yes, but in return you get incredible speed, flexibility, and access to capital that might be totally unavailable otherwise. It really comes down to opportunity cost sometimes, doesn't it? The cost of waiting weeks for a cheaper bank loan might be far greater than the higher interest on hard money if it means losing a fantastic deal. Okay, now, for those of you actually thinking this might be for you, our sources had a really handy investor checklist. These aren't just random questions. They're things you really need to reflect on to make sure hard money fits your specific goals and situation. Ask yourself, first, do you absolutely need fast approval to lock down a deal that won't wait? Second, is the property itself a short-term investment, like a flip, a major rehab for quick resale, that kind of thing? Third, do you have a clear, realistic exit strategy already mapped out, either refinancing or selling within that short hard money loan term? Fourth, are you truly comfortable with paying higher interest rates in exchange for getting cash fast and grabbing unique opportunities? And lastly, have you done your homework? Have you researched and found reliable hard money lenders in your area, and do you understand their specific terms and reputation?
Yeah, those questions are critical. They really get to the core of what the experts in our sources were saying. Like one U.S. lending consultant put it bluntly, hard money loans are not about the lowest interest rate. They're about speed and opportunity. That's a fundamental shift in thinking, right? It's about using the right tool for specific market conditions.
Yeah, exactly. And another source, a real estate broker, reinforced that, saying, in states like California and Texas, where property cycles move quickly and competition is fierce, investors rely heavily on private hard money loans to stay competitive. It really shows that for a lot of people in active markets, it's not just an option, it's almost a necessity to keep up.
And here's another sort of surprising insight that came up. While some people see hard money as a lender of last resort, maybe for people with bad credit, many really sophisticated investors actually use hard money strategically, not because they have to due to credit, but precisely because the speed lets them lock down deals so quickly that the faster return on their investment more than makes up for the higher interest cost. It's not just for emergencies. It could be a power tool for decisive players.
That's a huge point. It really flips the script. It's about maximizing opportunity, not just making do. And just to quickly cover some other key points from the FAQ sections we reviewed, just to clear up common questions people have. Rates, typically, 8% to 15% is the usual range. Credit is usually checked, but honestly, the property's value and your exit plan, those are the main drivers for approval. You can use these for rental properties, especially if the plan is to renovate quickly and then refinance into a better long-term loan. Funding, like we've stressed, is fast, often 3 to 7 days, And yes, they are illegal everywhere in the US, but the specific rules and regulations can differ state by state, so definitely check your local laws and talk to a pro.
So to kind of wrap this all up, it seems abundantly clear that hard money loans are, well, they're much more than just some niche product. They're a really practical, often powerful financing option for U.S. investors who value speed, flexibility, and property-focused lending over maybe strict credit rules and the slower pace of banks. Yes, the rates are higher, no doubt, but for the right kind of short-term project and the right market conditions, the benefits of getting that capital quickly and being able to seize those time-sensitive deals, they can often significantly outweigh the costs, can lead to much bigger profits overall, which I guess raises an important question.
Yeah, exactly. In a real estate market that really doesn't wait for anyone, where opportunity often just flashes by, how might understanding and maybe more importantly, strategically using a tool like a hard money loan fundamentally shift your own approach to grabbing those fleeting chances? It's definitely something to think about as you consider your own investment goal, your timing in the market, and the kind of competitive edge you want to build.